There's a problem with relying on somebody else like the government to fund your retirement. It's not guaranteed. In 2023, when France announced that they wanted to raise the retirement age when you can start collecting government benefits from 62 to 64, people rioted, they protested, but the bill continued through the government. Also in 2023, Argentina passed a law making it easier for their citizens to fund their retirement by getting easier access to government money to live a comfortable life in retirement. This sounds good, right? The problem is inflation. These new pension checks from the government aren't enough to keep up with the rising cost of inflation in Argentina. In the United States, it's a little bit different because every single one of us who gets a paycheck pays a little bit of our paycheck into a Social Security fund. This was created by FDR as a way to create an earned entitlement. It's called an earned entitlement because you earn it. You work to put this money aside into your Social Security fund. That way you know when you go to retire that you should be getting the Social Security money. The problem is, well, it's not guaranteed. Actually, let me rephrase that. The government can guarantee the checks, you just can't be guaranteed to have a comfortable life with these checks. The problem that the Social Security Fund is facing right now is they are paying out more money than they're bringing in, and Social Security is set to start cutting benefits by the mid-2030s. Now let me make sure I'm being completely transparent here. The government doesn't have to start cutting benefits, and there's a good chance that they won't start cutting benefits. How can they get more money to fund these Social Security checks? Well, number one is they can raise your Social Security taxes, which means more of your paycheck is going to be going into the Social Security Fund. Or number two is the government can just print bigger Social Security checks. I mean, the government can work with the Federal Reserve Bank to get more money, and then they can just send out bigger Social Security checks. But there is a cost associated with this. We know the cost with raising your Social Security taxes. It means more of your paycheck is going to the government. But the cost of the government just printing bigger Social Security checks, which they can do, is, well, inflation. Because now, yay, you got a bigger Social Security check. Except, oh no, you go to the grocery store and everything is 2 times more expensive, so you can get a bigger check, but that doesn't guarantee that you're going to be able to buy more things. Back in your parents' and maybe your grandparents' generation, retirement was considered a 3-legged stool, and the way that retirement planning worked is, in number one, you had your pension. Your company would pay you a pension after you retire, which would give you a guaranteed income after you retire. Then you would get Social Security from the government. So now you have the pension from your job, then you have this check from the government, which you've been paying into from your work, and then you have number 3, which is your personal savings. Well, what's happening now is these pensions are essentially extinct. Very few companies, if at all, give any sort of pension to their employees. Then Social Security is, well, drying up. And in order to fund now future Social Security checks, especially if you're under the age of 45 right now, chances are the benefits that you get from Social Security, even though you're going to be paying into Social Security for your entire life, aren't going to be as strong as, well, maybe your parents or your grandparents. So Social Security isn't going to be there the same way that it was, which leaves your personal savings, your investments, and the things that you do to fund your own retirement. And the problem with this is most people aren't given any sort of financial education. You can see why this is a problem because, well, most people didn't need financial education to be able to fund a retirement. But nowadays, when you don't have this sort of guaranteed income, you have to become financially educated and you have to start thinking ahead, because if you don't, you're going to turn 65 and then really be hit with a reality check, because now you're going to realize that you're not going to be able to retire and live the life that you wanted because you didn't prepare. This is why it is so important to understand this and then start building upon that financial education. The good news here is that unlike what the majority of people think, this type of planning doesn't have to be very difficult. I mean, Warren Buffett talks openly about what he says the majority of people could do to retire wealthy without becoming a full-time investor. Let me read you a quote from what he gave to CNBC. Warren Buffett's advice to somebody who wants to retire wealthy is, quote, consistently buy an S&P 500 low-cost index fund and keep buying it through thick and thin, and especially through thin. Here's what that means. Instead of trying to go out and finding the next hot stock to invest in, maybe let's just say Amazon, because when most people try to invest in a company like Amazon, they don't know how to decide if it's a good company or bad company. Sure, maybe you use Amazon, but how do you know if the financials are good? How do you know if the executives are good? How do you know if their profits are growing? How do you know if their revenues are growing? How do you know if they're investing their money the right way? If you're interested in doing that, you can learn about how to do that sort of financial analysis and how to do all the fundamental analysis. But for 90 to 95% of people, they don't care and they're not interested and they don't want to do that. The alternative to investing in a company like Amazon and betting on that, because now when you invest in one company, all of your eggs are in one basket. So if Amazon went bankrupt and you invested your money in Amazon, all of your money would go to zero. On the flip side, if you invest in Amazon and Amazon takes over the world, you would make a lot of money, but you're taking on a lot of risk. So what is the alternative? This is where Warren Buffett says, buy the S&P 500 index. The S&P 500 is a group of the 500 largest companies on the stock market. So now, instead of investing in the Amazon company, you invest in this fund that gives you exposure into Amazon, McDonald's, Coca-Cola, Walmart, Google, Apple, and hundreds of other companies. There are 500 companies in this basket, and now instead of trying to just invest in one company, you invest in this fund that gives you exposure to 500 different companies. That way now you don't have to worry about what each individual company is doing. You don't have to worry about listening to all the individual earnings calls. You don't have to worry about doing all the financial analysis. What he's saying is that just keep investing into this thing for the long term through the thick and the thin, especially the thin. That means when things go rough, when the economy is struggling, when you see market crashes, when you see a recession, you don't stop investing in this. You don't panic and sell out of this. You keep buying more. Historically, we have seen that this strategy has worked. Does that guarantee that you're going to always make money when you invest in the S&P 500? No, of course not. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own due diligence and never blindly trust a random guy on YouTube. But the idea is, if you believe in the American economy, and if you think in 20 years or in 30 years or in 40 years, the American economy is going to continue to be strong and it's going to continue to grow over the next number of decades, well, this is going to give you exposure to the biggest 500 companies in the American economy, and now you're essentially owning a piece of the American economy, and as the economy grows, well, so does your investment portfolio because you own a piece of the American economy. Listen to me, I'm not telling you what to invest in, I'm just talking about this as an example so you understand how to invest your money. But if you do want more education on how to start investing, how to start generating cash flow, and how to make your investments work, we have a free ebook in Market Insiders that goes over how to start investing your money. You can read this ebook for free. So if you want to read this ebook and continue to build your investing education, I'll put that link for you down in the description below. But there are a few different ways that you can get exposure into the S&P 500 index. One is through an index fund. An example is VFIAX. Again, I'm not telling you what to invest in, just examples for your education. And then you can also invest into the S&P 500 index through ETFs like VOO. As a disclaimer, I am personally invested in VOO and SPY, and I'll explain the difference between an ETF and an index fund too. This means if you invest in any one of these three funds, you are going to get exposure to the S&P 500 index. If you invest in any one of these, you're going to be owning those 500 companies, the 500 biggest companies in the stock market. And what Warren Buffett says is the way that you win is that you just keep passively investing your money into these funds through the thick and especially the thin. So no matter what's happening, you keep investing your money, whether the market's up or whether the market's down. But what's the difference between all these different funds? The first difference is that this is an index fund and these are ETFs. And the main difference between index funds and ETFs is essentially the way that they're traded and the way that you can buy them, because index funds tend to have a little bit more rules on what you need to do to buy them versus ETFs don't. The first difference is that ETFs trade like regular stocks, meaning you can buy and sell out of an ETF multiple times a day, and there's no limit to how many times you can trade an ETF within a day, versus with index funds, you can generally only buy and sell an index fund once in a day. The reason why is because index funds are long-term investments, so they don't want to encourage people to trade out of these index funds. Number two is the minimum dollar requirement in order to invest in an index fund versus an ETF. Many index funds are going to have some sort of minimum dollar requirement to buy into an index fund versus the ETFs don't. Like if you were to go out onto this index fund's website, and I'll pull it up on the screen here, you'll see that the minimum investment requirement is $3,000. That means you're going to need $3,000 to go out and invest in this index fund, versus with these ETFs, you don't have the minimum investment requirement. So now that we understand what the S&P 500 index is and how you get exposure to the S&P 500 index, how do you actually invest in these funds and how can you retire wealthy? Over the last 100 years or so, we've seen the S&P 500 grow by around 10%. This does not mean that the S&P 500 has grown by 10% every year. Some years it's lost money, some years it's gained money, but on average over the last century, the S&P 500 has grown by around 10%, and over the last decade, it's been more than 10%. Now again, this doesn't mean that it's always going up, but like Warren Buffett said, the way that you become successful at this is that you invest through the thick and especially the thin. If you can invest $1,000 a month and you get a 10% return and you do this for 25 years, you will be able to retire with over $1.2 million in 25 years with their $1,000 a month investment. Now you might be watching this and saying, but Jaspreet, I don't have $1,000 a month. Is there any other way for me to retire? Well, let's go into this because there are 3 different variables that will determine how wealthy you will become. You can take a look at this, which is the time. You can take at this, which is the return, or you can take a look at how much money you invest. These 3 factors are going to determine how wealthy you will or won't retire or become. And so now it's, can you influence how much money you make? Can you influence what return you get? Or can you influence how much time you invest your money for? We can't go back in time and start investing 5 years ago. So the best thing to do is start investing sooner rather than later. So this is the one factor, time, that none of us can change. But we can influence the return that we get, and we can influence how much money that we invest. When it comes to the topic of investing more money, the reality is most Americans don't have the ability to invest $1,000 a month today. But that doesn't mean you can't ever have the ability to invest $1,000 a month. And the way that you can have more money to invest is, well, twofold. You can work to spend less money, so you have more money to invest. And you can also work to earn more money. That way you have more money to invest. Both of these 2 things, you can do both of them, are going to create a bigger margin and bigger cushion. That way you make money and you spend money, and then you have this margin, which is money that you can invest. The bigger the margin, the more money that you can invest. So now, how do you spend less money? Well, you can buy less crap. Buy less things that you don't need. And if you're saying, but Jaspreet, I'm already living paycheck to paycheck. There's nothing that I can cut back on. If you're telling me that, and you have a $600 monthly car payment, if you have to put in the premium gas on your car, if you're financing your Gucci, if you're financing vacations, if you have a whole bunch of things that you don't need that aren't paying you, there are things that you can cut back on. Maybe you have to live in a smaller apartment. Now, of course, there's some people that are living as small as possible, but there are ways that most people, the majority of people, can cut back on. There are expenses that we can cut back on. And if there's nothing else that you can cut back on or that you want to cut back on, then you got to focus on here. How do you earn more money? Now, the nice thing is that the internet has made this type of education so much more accessible, so everybody can learn how to earn more money. You can go into YouTube, you can watch podcasts, you can read blogs on how to earn more money, and there are a lot of ways to earn money now on the internet, or by creating a side hustle, or by working to build your own business that don't cost a lot of money. So there are things that you can do to earn more money. Is there something that you can sell? Is there a service that you can provide? Is there something that you can do to provide more value to other people? That way you can earn more money. The key though is now, as you start to earn more money, or as you start to spend less money, that you don't take this money and go out and buy a new car, because that puts you back into the same situation in the first place. You want to take this extra money, then you want to invest it and put this money to work. That way you can build your long-term wealth. Now, how do you actually do this? Because I like when the system is automated. I have a system where for me it's every Wednesday. It does not matter what day you pick. I just pick Wednesday because it's in the middle of the week. Cash is pulled out of my checking account and is automatically invested into my portfolio of ETFs. This happens every week, whether the market's up or the market's down, and this is a long-term investment strategy. Now for me, I like it automated because now it's simple, and that way I don't have to think about it, and that way I don't forget to actually do it. I use a platform called M1 Finance. They have been a sponsor for me in the past. They are an affiliate from Minority Mindset, meaning if you use my affiliate link, we will get compensated. Okay, you don't have to use them, do your own research. I just like M1 Finance because it's simple to use and they don't charge you any money to do this type of passive investing, and it can be completely automated, so you can find your portfolio, you can build your portfolio of ETFs, you can sync it with your bank account, and then anytime you can build a system, anytime you get paid, where now money will automatically be pulled out of your account and then be invested into your portfolio of ETFs. So if you want to learn more about M1 Finance, I have my affiliate link down in the description below if you want to check that out. When it comes to getting a higher return on your money, you just need to understand the risk versus reward formula, because generally, the more risk you take, the more potential you have to make more money. There's a guarantee you'll make more money. No, of course not. Because now, if you keep your money in the bank in a savings account, this is generally considered to be less risky because now, well, your money is sitting there, and as long as the bank doesn't fail, you should be able to access the money that you put there. The problem here is you're not going to get a return on your savings. Maybe if you put your money into a high interest savings account, you'll earn some interest, but it's still not that much. So you can earn some interest here, but it's the least risky option. Option number 2 is you put your money into a bank CD, a certificate of deposit. Now, you'll earn a little bit more interest here because now you're tying up your money in the bank, because with a CD, you can't pull your money out without paying a penalty. So your money's tied up, you take on a little bit more risk, but you're still not getting that high of a return. The next option is investing your money into stocks or real estate. One way to invest your money into stocks is to invest into things like the S&P 500 index. There are a lot of different types of ETFs out there. The S&P 500 index is just one example. You can invest in the total stock market. There are funds that give you exposure to that. There are funds that give you exposure to healthcare. There are funds that give you exposure to tech. There's funds that give you exposure to international companies. There's funds that give you exposure to real estate. You get the idea. There are a lot of different ways that you can invest your money in the stock market, or you can invest your money directly into real estate. You can buy properties, rent them out, and then you can get cash flow. And if real estate prices go up, you benefit there as well. This is more risky. They keep your money in the savings account, but you can also make more money, so you can get a better return. If you want to take on even more risk, well, you can work to invest in other businesses, or you can work to invest this money into your own business. Now, this is more risky because most startups fail, but you can also make way more money. There's no limit to how much money you can make with your business. There's a lot of businesses that started with $1,000 or less that have become multi-million-dollar businesses, and some have even gone on to become multi-billion-dollar businesses. So there's no limit to the types of returns you can see here. And then if you go on to the even more risky side, is you can gamble this money. Now, when you gamble this money, you go to the casino, you go put this money into a lottery ticket, you're probably going to lose. You have a 99.999% chance that you're going to lose all this money. But if you are that one lucky person that can turn your $1 into $10,000, now you can make a big return. I'm not advocating you do this. This is a way to lose your money, but you can start to see low risk, low return, high risk, high potential return, but you're probably going to lose all of your money. So now, when you put in those 3 factors, time, return, and the amount of money invested, this is what's going to determine how wealthy you will become. This is important for you to understand because, unfortunately, no one's coming to save you. And, you can hate me for saying this, but my goal is to educate you. That way you can be more aware and put the steps into place to take care of yourself. Because it doesn't matter what's going on in the world. I mean, yeah, we can ask the government to take care of us, but at the end of the day, you want to make sure you can take care of yourself, that you can take care of your family, and you can take care of your community, and you don't have to rely on somebody else because then you're living on their terms. If you can build a financial education and put the steps into place today, well, then you will be able to take care of yourself financially, and then whatever else is happening is just icing on the cake. But you can make sure that you take care of yourself and your family, and that means you understand how to get the best returns, how to invest your money. You know how you have the money to invest, and then you have the time, which means you invest sooner rather than later. Next time you get $1,000, don't go out and buy a new watch. Instead, there are 5 things that I want you to do with that money that we can turn that $1,000 into $10,000 or $50,000 or even $100,000 or more. Gotta get my watch back on. You've probably heard people say that you need to invest your money to become wealthy or invest this money into yourself